charge the mic.
Well, so thank you guys all for being here, and thank you guys for being part of this panel. So what I really wanted to address with this panel was the startup founders' kind of path to their journey to funding. So you guys have all secured funding for your startups, for your businesses, and kind of sharing that journey. I think there's a lot of misconceptions on that journey. I think one of the biggest myths is I've got an idea, and now because I've got that idea, I'm going to go find somebody to give me money to go execute on this idea. And I would say, one, a lot of businesses don't even need outside funding. They need to go make money. But every journey is different, and you guys represent a broad range of entrepreneurship journeys to funding. So I was glad to have you guys be part of this panel. Could we go around and just do a little introduction on yourself and a little bit about your company?
Sure, absolutely. So good morning, good afternoon, Jamie Lujan. The company on the flyer is Saluzo Business Solutions. So that's a consulting company that I have for businesses along with organizations that serve small businesses. So that's technical assistance, scaling, capital investment. Prior to that, I was a co-founder. Myself and my partner were co-founders in a company called Athletified, and we'll be talking about that today. And then we're also co-founders in a company called 52 Ventures, and that is an investment and advisory firm that also has the ability to deploy capital directly into companies. So, and that's the other company that we'll be talking about today.
Good.
Yes.
Thanks.
Anthony Franco, CEO and founder of a company called MC Squares. We're a direct-to-consumer manufacturer of office products, reusable office products. I'm a serial entrepreneur. This is my fifth company. The four others were bootstrapped, exited. This is the first one that I've needed outside capital for.
And Anthony did not mention, but he was on Shark Tank, and there's a lot of kind of interesting things that went along with that. And something that he shared with me is meeting one of the personas that they needed for the show, which is also part of the journey. So at some point we'll touch on that.
Sure.
I'm Samantha Citro Alexander. I am the co-founder of Bitewell. We are a corporate food health program, so we are B2B SaaS, essentially. We act as a benefits platform connecting your food budget and your health budget. And my background is primarily in marketing, strategy, and ops, so I come from a broadly corporate background, from smaller scale companies through to multi-billion-dollar corporations, and this is my first startup experience and fundraising experience. Never going back. I'm never going back.
My name is Francisco Lujan. As Jamie's mentioned, co-founder of a company called Athletified. But prior to that, serial entrepreneur. So first company exited. That was a bootstrap company. Started with a credit card, which is not the way to go, 100%. Then after that, went into the next phase of building out Athletified, which was where we took outside capital. And then from there, I've had multiple companies in between that have taken outside capital. And then now partner in a investment advisory firm called 52 Ventures, which focuses strictly on BIPOC women-founded companies and how do we put money into them to help them scale, but to really impact the communities directly. So how do we drive them to get more, how we give them to create more job creation and different things like that by putting money into them. But really understanding and what I think the purpose of this panel is how to use that money wisely, right? That's the biggest thing I think is all of us are sitting here as founders is, hey, it's great to get money, but what are you going to do with it when you get it, right? And that's what can you take on bad money that you're like, all right, took on this money, what's happening? So hopefully we get through all that today. So pleasure to be here.
So, a lot of businesses, I think there's a myth that like, I've got an idea, let me go pull down funding to execute on the idea. And in reality, at the end of the day, every great idea needs to turn into a profit-making business. That's what makes it a business. Even nonprofits make money. They need to make money to stay afloat and operate their business. So what caused you to seek funding? Why did you, on your first business, why did you think that you needed to go seek funding for your business?
So really, when we look back to the first business, and I want to address a point that you made first, is there a market need for your great idea? right? Your great idea makes a lot of sense because of the path that you've kind of walked, right, in your journey, depending on when you start your entrepreneurial experience. I would say before we're even getting to funding, before you make I guess maybe not make a website, but before you start deploying any sort of capital into a business, is doing the market research, doing the industry research, product, what is out there, right? Just because you haven't necessarily bumped up against it yet doesn't mean that it doesn't exist out there in the world in some form or fashion. And so even before we get to the point of capital, is understanding the market in which you're diving into. And so I think that's an important part before you even get to like, what is my capital stack going to look like? How am I going to, do this? So the point at which we took in capital really came from, we know it's a good idea. We've started to test it. Again, the first company really was, we're going to gather the people that we know. It was an events-based company. And so we didn't have a good path on how we would monetize the data that we were collecting. It really was an events-based company, and we needed the capital, right, to keep going. We had ran out of what we had in reserves. Started to dig into the credit cards a bit, and it's like, okay, how are we going to sustain this? As well, at the time, right, I had full-time employment elsewhere, and so it was kind of like, okay, you step out first, and then I'll step out second. And so it was really the running out of, right? It wasn't a good strategy. It wasn't a good plan. And I think that's one of the pieces about entrepreneurship. Just because you open a business does not make you an entrepreneur, right? And so really understanding that piece of the equation.
And I would just kind of also add to that, the understanding your runway. Do I have enough money on my own, or can I get it through friends and family to get me to that profitability spot? And if not, then how do I seek funding to get to that profitability?
I just want to point out, you make a lot of good points, but a lot of really great companies, startups, did none of that.
Oh, right.
Facebook, I did none of that with any of my startups. Not that they're all great, but there's different journeys for different entrepreneurs. Mm-hmm. And sometimes people get lucky. Like, I think there's a big luck factor in it. People just get lucky with an idea that happens to hit the market.
Hashtag luck factor.
Yeah, there's a huge piece that you look at somebody and go, how the hell is that person successful? It's timing. This last company, the company that I have now, MC Squares, we entered a market that didn't exist. It failed for years until we hit on something. We just figured it out along the way. We're still not there. I kind of joke, you're not a company. You're not a company until you have hats. We don't have hats yet. So we're still figuring it out. But yeah, you make good points. You should do that. And it's okay if you don't, but you have to get lucky.
On that note, we should all pull in for some hats so that we can make Anthony lucky.
No, we're not ready yet.
We just made hats, so I think we're real. We just made hats and T-shirts. So look at that. But to your point on timing, I was at an event yesterday morning, and someone brought up a Y Combinator stat that the number one factor of the success of a startup is timing. Are you entering the market at the right time? So it's just so true. But to your original question about funding and how we decided that we needed funding. So we are a high growth tech startup. We are the prime candidate for venture capital. And so for us, it made a ton of sense that we need to go out and get funding. We now see a point of profitability in the future. When we started out, we didn't. We weren't sure what our business model was going to look like. And what I think is true across the board for early stage venture is at the pre-seed and seed stages, what people are investing in are the people. So do we believe in these founders and their ability? Yep.
Or the
jockey, not the horse.
Yeah.
Do we believe in these people and their ability to solve, number two, this problem that we see in the world and believe is a real problem. And if these people solve this problem, is the market size large enough for me to see the return that I need to see to deliver on what I need to deliver to my LPs? So if you can think about those three factors, are you the right person, or can you get the right people around the table? Are you solving a quality problem, and is that problem in a large enough market space? And if those three things are true, then perhaps you go out and seek
I think
venture funding.
that's an area where a lot of founders miss is the invest, like, what's the return for the investor? It's like, it's always self-centered. Like, what, I need money for my thing. And it's a great idea, but they miss that critical component. Is like, okay, so they're doing this not because they believe in me, because they want to make a return. And how am I going to convince them? How am I going to be a good steward of their money? Yeah.
So very good points all the way across the board. So it's funny you guys talk about the hat and the T-shirt. Well, when we got a hat and T-shirt, we actually went into collections in the first business. So we weren't ready for that part of it all. But the key thing is in she hit it on the nail on the head with the situation of VC, right? When VC's looking, she's a candidate, right? SaaS product, that type, we can scale it, we can do the stuff. They need money, right? I didn't realize our second business, Athletified, was actually a software company. We still created it and said we're a data company. We're going out and doing events still, and that's how we get our revenue, right? And so that point is, I didn't know how much it cost to make an app, to build an app. I didn't know how I needed to make sure that was maintained. I thought once it was built, I was good. But then I'm like, every single day I'm calling like, hey man, I need you to do this. I need to do this. Now it's down, all these type of things, and continue not to know all that capital was needed. So once we seen that, we had to raise, right? We had to understand it, because we were like, our run rate is short. Right. The other thing about it is your cash flow, right? That's really going to be a big factor in determining how much money you need to raise, because when you look at your cash flow, especially product business or whatever business you're in, your cash flow, you're going to be able to tell how long is your runway going to be from that, and so on and so forth. When you're in software and technology, it's a little bit different, because you're always building, right? Because even if you stop today, you got to catch up with the market tomorrow, because something new comes out to the market. So you got to always try to be one step ahead. So that's what you really got to understand, your market sector more than anything, to understand when does that money need to be raised, because at that point you're going to be able to determine it. And you could do projections and all that type of stuff, but once you know your cash flow and understand that more than anything, that will help you determine when you need to pull that outside capital. You know what I mean? Because when we did the events business, it was very cash flow. We knew our cash flow, right? We do an event on Saturday, there's 100 people showing up, we know how much money's coming in, great. That's gonna allow us to last for the next 3 to 6 months. Then we do another event. We lost. Okay, now we got to panic a little bit more. And so once you understand that more, it will determine a little bit better. That's why credit cards came into place, because we're like, we only have to bridge $2,000. Then it was $4,000. Then it was $6,000. And then we're like, dang, all right, now we got to start looking for a little bit more, because we just need something to layer it. So, and then also understanding what type of options are out there, right? VC's a way to get money, angel investors, all these things, but there's debt financing, there's institutional financing, there's lines of credit, all these different ways. What's best for your company? So there's just a lot of things that you have to evaluate, whether you are doing it alone or whether you have your partners, and sitting there and just kind of walking through it, but always understanding what your business looks like and trying not to go outside those means, because that's when you get yourself in trouble, right?
Well, so we'll kind of do Q&A in a little bit, but so that brings up kind of the next point of a lot of people don't know when they've got an idea. I've got a great cupcake recipe, or I've got this tech solution's gonna save the world, but they don't know routes to funding. They don't know the expectations of what that funding is. An SBA loan can take 6 months to a year.
Right.
An angel investor isn't gonna write you a check on the first date. So, and then kind of going through the panel, if we could pass down again, what did you, when you first kind of came into it and you were looking for funding, what thing now looking back where you're like, I got that wrong? An angel investor, with the expectation, and what did you learn from that?
Definitely how long it takes, right? So how long it takes to go, especially if you are going to go VC, if you are going to go into any of these other spaces, how long it takes from the time I first meet you to the time we meet, you do due diligence, we meet again, you meet the team, like write the check, like all of the different pieces, timing, I would say first. And then the other piece that I think we got wrong was not understanding, not doing basically a risk and rewards, right? What does this type of financing come with? Risk and rewards. And so better understanding that is a huge component. Now that we're in the space where, we're getting pitched regularly, we're sitting with companies regularly telling us about, their plan or their great idea or their capital stack. We're always looking at who's already on the cap table, who's already in this mix, who are you getting me into business with? We didn't understand that, going in, that when we were speaking with VCs, it was a very kind of like, oh my gosh, they're way over there. Well, when you take that type of money, they're very right here. And I think what we got wrong was not understanding the timing and not understanding it from their perspective, and realizing that you're making them new business partners, along with all the other people you already put on the cap table. So I think those are the things we got wrong.
Great answer.
What didn't I expect? How hard it is to wrangle cats when wrangling investors. And the other thing that I think is really interesting is, as your company matures, your investors mature. So angel investors, in my experience, are in it for the journey as much as the ROI. So it's kind of like there's an entertainment value. Like I want to see where that guy goes, right? He's crazy. There's investors that make those kinds of bets, right? Just because he may lose all my money, but it's going to be fun being fun part of that journey. So when that may be true in the early stages of capital raising, but once you get into real money, 500K and up, they're much more worried about. They're a lot less concerned with how fun it's going to be, and a lot more concerned about the business in general.
Anthony, hold that mic for just a second. So you were also on Shark Tank, and I think when we watch Shark Tank, we think, oh, you pitch to the judges, to the sharks, they critique you, and then right after that, you're funded and you're off to the races. So what did you learn as far as that path to funding through Shark Tank?
Well, I mean, I don't know how useful this is. 0.08% of everybody that tries out actually gets a capital from a Shark Tank shark, but it's an interesting story. So we pitched. So I spent 4 years trying to get on Shark Tank. Pitched 5 times before we finally got our film date. Pitched in June of 2019. And it's real. So when you're there pitching, it is truly the first time they see you. They know nothing about you. In fact, the producers make sure that you've never had any connection. You sign affidavits saying you've never connected with the shark before. We pitched in June of 19. We aired in May of 2020. So almost a year later. I closed the deal with Kevin in August of 2020. So it took more than a year to close that deal because he was doing due diligence. He didn't tell me this, but if I'm in his head, it's like, I want to see if you guys air, because not all pitches air. It's like, I want to see if you guys air first and how you handle that air date, and then I might invest in you. A lot of entrepreneurs, a lot of deals do not close because start digging in and go, wait, this guy was full of it. And so they walk away from it, as they should.
Yeah, I think that because that's so public and there's so many misconceptions, but it also is true to life though, in that it's not like you pitch and you get a check at the end of the meeting. That's just not how it happens. And a lot of startups, they seek funding when it's already too late, and so that timeline already is you're gonna be below water until that relief comes. So go ahead, Sam.
Yeah. So, as a first-time founder, I purposefully sought out a co-founder who had been through this multiple times, to help me see the things that I wouldn't see. I had thought about, starting something of my own for a long time, but never felt comfortable taking the leap. And then when I met Chris, and Chris had this incredible idea, was looking for a co-founder, had my skill set. It was a perfect match. So he has helped and been a great sounding board for me as we're going through the fundraising process. Our process has looked like we had a little bit of friends and family money. Then we went through an accelerator program with Antler. Then we took in an angel round. And then we did a pre-seed, and then we did a bridge. And now we're raising a seed. And so we've raised multiple rounds of financing that all look different. I think one of the things that I didn't think through as strategically when we raised our pre-seed, as we are now when we raised our seed, is in addition to capital, what am I looking for from my funding partner? Now going into this round, we're looking for two very specific archetypes of VC that help us to further the business and bring it along. When we were raising our pre-seed, we were just like, we need capital. We are almost out, and we need to find a partner who believes enough in the business as it is today to give us funding. So yeah, being a little more strategic about who and why.
So back to Jamie saying it, because she covered a lot of what we went through. But the biggest thing is, how many dates have you gone on to find your wife or your husband? It's about the same exact thing. If you're not married, then you'll understand the same way of raising money. Because you got to remember that person is now a part of you, right? They're now your partner that you now have to, they're going to ask you every day what's going on, or every month, however involved they are. And that's one thing that you have to get used to, right? And then also knowing who they are, right? They may be amazing people at the beginning, and then before you know it, they turn, right? The business isn't going the way it is and all that stuff. And now they become more of a headache, more stress and everything on you, that you're not able to function the way that you need to. So you really have to do a lot of due diligence on that, and not knowing that is probably the hardest part, because you're like, oh, he has money. Great. He can write me a check. I want him as a partner, if you don't really understand the game, right? And that's a hard part of it, right? Because a lot of it, when you're sitting there and you're talking to them and you're like, oh, I love them, they're the perfect fit. And then you do a little research on it and you don't know what else has happened, or with her that invested into you, you don't know what happened with her, all these different things that happened. So some of our early on investors, that they became problems later on down the road. And it wasn't right away. It was a year later, you know what I mean? It was a year and a half later that caused more and more things. And we thought it was strategic, but we didn't see the red flags early because we were so blinded by the money. And if you would have looked at the personality and how they treated other companies they invested into, you already knew it wasn't a good match. And so that was one big thing about it. And then she hit it perfectly. You need to have somebody alongside of you that's knowledgeable in raising funds and what it takes. Because what everybody thinks is that, hey, you know, I mean, I don't know how many calls we've gotten, you know, now that we have our capital and we invest in companies that, hey, I need money tomorrow, right? Hey, if I don't have money by Thursday, I'm going under. And it's like, well, we got a long way to go to get to that point. So it's understanding that timeline more than anything, because
asking if you married on the first
yeah, exactly. It's exactly it. It's rare. You better go hope that you got some cousin or uncle that's going to give you this money. But that's the thing, the timeline of it all, and understanding, because being on the other side of the table right now, founder side was we learned so much, and then now being on the other side of the table, we know what goes on, right? And when we're talking to each and every one of the different companies that we're looking at, or, you know, doing due diligence on and everything else, we know what they're going through. So we understand that, but we also know on our side we can't move any faster, because we have to make sure they're a match for us, right? And I hope they're doing the same thing, but they're in such panic mode because they need money tomorrow, right? It's just a hard thing. So never put yourself in that tight spot, right? That's the number one thing I would say, because then that just makes you jump immediately, and then you don't do your own due diligence or go on that date. Exactly what it is getting married on the first date, right? It took me a long time, a lot of different partners. No, I was joking, to get to that part, but that was the whole thing. So that's just my a little bit.
So then the next question is, there's kind of a misconception right now that you can just find all these answers on YouTube. And I kind of lean towards, you don't know what you don't know. Mm-hmm. So then how do you go search for that on YouTube? So how did you initially learn these different things, like how to assign equity and the importance of building team and all those different things that you probably have a better understanding of now, but probably still even learning to this day? Where did you initially find the information to help you fund your business?
Sure. So our I mean, our path again was very roundabout. So when we're talking, 10 years ago, you're young, you're not seeking, again, I think the conversation around VC, angel, all of these things that I think today are very different in the ecosystem around funding a business. I don't think, maybe we just didn't know, but they weren't part of the conversation when we first started out, right? It was, oh, I got an idea. How much do we have? Let's go do an event. And it kind of snowballed from there, right? Again, right? We bought all the t-shirts, all the pizza, all the, we're going to be big. And so when you talk about like, where do you go? What do you do? How did we do it? It was very much a kind of, error, just like oh, that wasn't the right path. Okay. How do we come over here? And I would say our first exit, it didn't feel like, oh my gosh, I think especially in tech or now being in the space, people feel like, man, I'm going to start to exit, right? I'm going to build, and then I'm going to exit. Our exit almost felt a bit painful because you're like, man, I've invested so much time and energy and, passion and love and all these things. And now, we didn't get acquired and continue to run the company. We got acquired, and it was like, okay, now we're dismantling, and this is what's happening, and we're taking the best of this, and you're like, whoa, what the heck just happened, right? And so I guess I would say, where did we go? It was very much like doing it, seeing what worked, keep doing it, seeing what didn't work, try it different the next time, right? Again, with serial entrepreneurship, I call us the land of the misfit toys, where we keep trying, right? And we try to take the best of the previous experience and move forward. And I think now, again, being on the investor side, is better understanding what are incubators doing, what are accelerators doing, how are they preparing their founders, are some doing it better than others, can we point folks to ones that might be mission aligned with them, can we get involved in communities that are mission aligned, right? We're very much focused on BIPOC and female founders. If you're outside of that scope, we're probably not the best investor set, but we can point you in other directions, right? And so I would say it was a trial of errors, and just continuing to better get to know the ecosystem that you're operating in.
I really identify with the exit. Like I've had 4 exits, not a single champagne cork moment. They were good. Like they were, but there wasn't like, all right, we've accomplished it. I'm done. All right, practical advice, right? So where do you find it? First of all, if you're thinking about raising capital, go get Venture Deals. It's a easy read. It's a great book.
It is.
And you're gonna be a lot more educated when even talking to friendlies that aren't going to invest in you, right? So Venture Deals, you have to go get it. As a founder, you have to go get Venture Deals. The second thing I would say is, if you're thinking about being an entrepreneur, don't. You're going to lose. The third thing I would say is, and the odds say you are, right?
Huh?
Don't do it. The odds say you shouldn't do it. The third thing, if you're dumb enough to ignore that advice, think about the different ways to fund your business. Best way to fund your business is revenue. Without a doubt, don't need somebody else's outside capital. The second, I wouldn't call it best, but a possible scenario is debt. I would encourage any entrepreneur of any business that's going to go raise capital to go get a loan, not credit card debt, but go get a business loan as soon as you can. Make it small and make it something that you can pay back so you can establish business credit. It is an out that helps you bridge. That is, I think it's an undervalued asset. Is your business credit is a very undervalued asset. Third are all covered in the venture deal space, like convertible notes and angel rounds and seed and venture. One place I would avoid is lines of capital that are tied to payback based on your revenue. Those are predatory loans, so very much avoid. We'll take 6% of your revenue for the next 20 weeks. It's like 50%, 60% APR rates. It's predatory. So avoid debt that is predatory. Buy a piece of equipment and get an equipment financing loan to establish a line of credit. You're talking about capital advice, YouTube. Yeah, that's all I got to give on fundraising.
Yeah. I talked to a lot of people. That's how I learned. I read Venture Deals. I read Hard Thing About Hard Things. There's like a list of books. You can find this list through Google. Probably 8 or 10 books that are highly recommended for anyone raising venture, if that's the route that you decide to go. But the best advice that I've gotten has been from other founders. And so find founders in your network, find people who know founders. If you reach out to, what my experience has been, if you reach out to any founder and say, hey, this is where I'm at in my business, I would love to know how things went for you. I have questions about how to raise funds. Any founder will pick up the phone. It has been a very supportive community of people who want to help each other.
Yeah, they all took all the good stuff. Yeah, your network is your key. That's what it is, and like I say, is the more you could go out. So the businesses we've built has been all built off network. We've worked with every major brand that you can think of in the sports industry, and with every major sports celebrity you can think of too as well. From that, but that was all by network. It was all trying to go out and different things like that to figure that out, so we can understand what we were exactly doing. And then when it comes to the fundraising side of it all, YouTube, TikToks, and all the other stuff that's available now wasn't around when we were raising. Our first company, literally, it goes to the entrepreneur side of it all. I made the decision two hours before I was supposed to get on the flight while we just had our first kid. And I'm like, I'm going. And I got on a plane and flew down to go start a business. Do not know why I did it. Exactly to the point. But with that being said, is you got to, that network is just so key. But it's also, even within the network, how do you use the network? That's probably the number one strategy you have to figure out, because I could have 10 billionaires in my phone, right? What are you going to do with those 10 billionaires? Even if you have a relationship, what are you going to do? What are you going to ask for them? What does it even mean? Because the thing about it is, if I pitch it and said, hey, you want to invest in my business today? He's going to be like, all right, well, send me your stuff. And then you send him stuff, great, whatever. And then you may not hear from him for a month, but you keep hitting him. He's like, I got 50 of you that do this to me every day, you know what I mean, type scenario. So it's understanding how to utilize your network, which took a long time, honestly. So it's a lot of trial and error, you know what I mean. I can't even imagine, I couldn't even tell you how many people we've been through, as far as like has been close, we thought we had something and then fell off, close, thought we had some and fell off, all the way through, just because exactly like the dating goes right back to the dating situation. How close can that group be, and understanding each other so you can actually do something. But YouTube, yeah, it's great to, you just get just nuggets of it, but it's all self-taught, right? It's trial and error. It's like anything in it, you know what I mean? I should never be an investor, but since I went through so much now and everything else, they finally said, yeah, you need to be an investor, and you've done the right things, because you can teach others that you'll be able to invest into to help them on their journey. So that's really what's happened at this point.
So, go ahead.
I was just going to say, the other piece too, right, that I don't think gets talked about nearly enough on the investing or on the capital side is the importance of clean books. Clean books. Always, all the time, not just in tax season. And I think we really saw during the pandemic when, there was, help available through, different types of loans or grants or different types of programs that businesses just could not access because they didn't have clean books. And so I can't stress that enough, particularly not only when you're using your own capital, when you're using other people's capital, when you're going to raise, when you're doing your projections. I mean, just all of the things. Keep your finances in order and do not mix them with your personal finances. Keep them entirely separate. They are two different entities. They have two different purposes. I'm just going to do this real quick. I'm just going to pay for this real quick. Don't do it. And so I just don't think it gets talked about enough in the journey, and it's not until you're in trouble do you understand how much in trouble you are? So I just want to hit on that.
Great point. And it kind of leads to, and we're going to wrap it up. So I've got 2 more questions. So one bit of advice that if like you could tell yourself when you got started, look out for this thing or do this thing, what advice would you give yourself? And just one example, and then we'll wrap up here.
I think when we got started, I would say you should, right? And going back to the point, like I would never encourage somebody to go be an entrepreneur. I think you have a great idea, you know it's in you, and if you go down that journey, keep going, because it's going to be so hard and it's difficult and it's tough. We've been, I think, blessed and challenged with being in the same household and going through this journey and being able to say, this is the line, particularly when you take friends and family money, this is the line of business, this is the line of personal, and you're going to get challenged with, should you keep going and do if it's in your spirit, right? Listen to the voice that says you can, because you can, and you will figure it out. Listen to that voice. And if it also says stop, figure out how to stop in a way that allows you to come back if and when you want to. Don't ghost people. Don't just drop off. If you can, try to say, hey, I'm really having a challenge, to your network, and figure out how to stop in a way that allows you to breathe and come back if that's the path that you choose. But you can.
I'm trying to think of something that I would have listened to 20 years ago. I would have told myself to go to hell. Like there's nothing I would have listened to myself on. So I can't think of anything.
Sometimes you just got to be stubborn, even within yourself.
Mine would be, don't wait until it's perfect to put it out. Just like make something that helps someone understand what you're trying to build and put it in front of as many people who are your customers as you possibly can. Because once you get it out there and you get their feedback, it will change a million times.
Don't start a business with a credit card. Best advice ever. Because it never ends. It continues. It did. Yeah. But I'm just saying, if I could go back to myself, I would have figured out another way.
But the question is, would you be here if you didn't?
Man, we can go long. We'll be here all night if we go into this one. We'll talk offline on this. No,
bad
but he was the point of the question was, if I went back to my former self, would I say that? No, looking back, but yeah, that would be it's just advice, right? On it. And that if you want to get away from that part about it is one thing I would tell myself back then is to create an asset that you can leverage, whether that's a real estate asset or whatever it may be within the business, because exactly going back to his point is once the bank sees it, they have an asset they can leverage against. It's a lot easier to get money. That's a thing. Even though like I had IP with software and all that stuff, they don't care about software. You know what I mean? They're like, we don't know what code means anyway. I'm a banker. I know that you have a house. I know you have land. I can leverage that, and you can leverage it all day long in multiple ways. And if you see a lot of the traction within, how real estate and how you can, evolve your wealth by real estate investments and so on and so forth, it's true because of how you can leverage that asset for so many different ways for capital. So that'd be one thing.
And then I just wanted to wrap up with how can people find out more about each of you guys? Social media, website, and you guys.
Yeah, LinkedIn. So Jamie Lujan on LinkedIn. The web, we like kind of Facebook a bit, but I would say LinkedIn. That's the best way. So Jamie Lujan, Saluzo Business, 52 Ventures, Connect. There's also, Denver Startup Week. I mean, there's all these different events. There's, Tech Alley, all of these different places. Come, we'll be here. And thank you for coming out.
LinkedIn, Anthony Franco, or mcsquares.com. Yep.
Same. LinkedIn, Samantha Citro Alexander, and Bitewell.com.
LinkedIn, Francisco Lujan, and then 52 Ventures.
And I just wanted to wrap up for the people watching the videos later, and for you guys, thank you guys all for sharing your journey. And every entrepreneur's journey is different, and it's always going to be that way. And the path is not textbook.
Look, Mom. I made that.